Hello and welcome to Asking for a Trend. I'm Josh Lipton. For the next half hour, we are breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. Gold took off like a rocket ship in 2025, and analysts remain generally bullish on further potential highs for the precious metal. We'll explore how the surge in gold is impacting miners. That's next. Plus, could manufactured housing see a renaissance in 2026? The oracle of Wall Street, Meredith Whitney, shares potential real estate investment opportunities coming to the market this year. And millions of federal student loan borrowers could face wage garnishments. An expert will break down everything you need to know about this development. Well, gold prices skyrocketed in 2025, surging over 65% amid tariff uncertainty, strong demand from ETFs, and central bank buying. The rise in the yellow metal meant a big boost in shares of gold mining companies, all up over 100% in those 12 months. Joining me now to discuss what's next for the sector is John McCluskey, the CEO of North American miner Alamos Gold. John, it is great to see you. Maybe start here, John. Listen, you've been watching this blistering run, John, in gold. I'm just curious what you make of it, John. What are the tailwinds, and are they sustainable?
You know, what we're in is a multi-year run in the gold market. Frankly, it's been going up for 10 consecutive years, not as dramatically as it did in 2024. But if you go back to 2015, for example, the gold price was hovering around $1,100 an ounce. And we were aggressively acquiring at that point. Between 2015 and 17, we did 3 back-to-back acquisitions, and that's worked out very, very well for us. And you know, with a further run in the gold price, you could just imagine the effect that's having on cash flows for all the producers in the sector. And those cash flows we're using to fund our growth, and that's just an excellent timing on our part, and yeah, we're all the gold producers are enjoying this run for sure.
You know, John, one argument I've heard is a lot of the run in gold, so the argument goes, can be chalked up to this, that the EU's decision to freeze Russian central bank assets. And so other central bankers around the world said, okay, we better own something that can't be taken from us. And I'm just curious what you make of that.
There's a lot of truth in that. I think it doesn't essentially explain everything, but it certainly explains why countries like China and all the countries that trade with China, Russia and countries that trade with Russia, why they've been accumulating gold. And you know, it has also to do with the heightened political risk in the world. It has a lot to do with the economic uncertainty created by this new American administration that basically has been very aggressive with tariff policies and so forth. There's a whole raft of reasons why gold has been sought after by investors, and frankly, investors are only coming to the table now. I mean, it's mostly been central bank buying, as you pointed out, but investors are coming to the party now, and I think that's why gold has a long way to go yet.
And John, let's dig into your company a bit more too. I mean, just walk me through, John. I'm curious, how many mines, John, do you all now operate, and how many ounces of reserves, you know, versus 3 years ago or 5 years ago?
Yeah, so we produce from 4 mines at 3 sites. We have the Island Gold Complex, which effectively has 2 mining operations. Then we have a mine at Young-Davidson, and we have a mine in Mexico called Mulatos. We're building a 5th mine right now called Lynn Lake. It's fully permitted and under construction. That's in northern Manitoba, Canada. So 90% of our value is in our Canadian operations. And you know, back in 2015, we had no Canadian operations. We made a decision then to pivot to far safer political risk jurisdictions, if you will. We divested of assets and focused on Canada, and we've really grown our business here. And that's been a very astute move as far as our shareholders are concerned. And I think that's really underpinned the rapid growth and value of the company. It's also come along with strong growth in production. Our costs have come down, so we've been generating excellent cash flows in a rising gold price, and we're continuing to grow. The interesting thing about Alamos right now, if there's a thing that differentiates us from the pack, is the rate of growth that we're undertaking between now and 2028. We're effectively going to double our production between now and the end of 2028, and that's a growth profile that I think very few companies can match. And we're doing that all in safe jurisdictions at low cost. I think that makes a really compelling investment for the market, and that's why we're doing very well.
Well, one theme that's interesting there, John, and correct me if I'm wrong, but many miners, my understanding is, are actually diversifying away from Canada. And as you just pointed out there, you're committed. How come?
I hate to disagree with you like that so blatantly, but frankly, other than companies like Barrick and Newmont that sold Canadian assets, and frankly, they've been diversifying away from gold and into copper. Virtually every other company after those two have been acquiring assets in Canada. So they're more the exception that proves the rule. And I would say that the companies that pursued acquisitions in Canada have done very, very well. And if you look at the companies that purchased the assets that were divested by Newmont and Barrick, those companies have done extremely well. So where do you go? If there's only 3 or 4 countries in the world that have meaningful gold production that I would consider to be really politically safe jurisdictions. Those would include Canada, the United States, Australia, and so on. But after that, you're taking on risk that's really difficult to quantify. And we've seen the problems that Barrick has run into in Africa, and Newmont ran into in Southeast Asia and in Kyrgyzstan and so forth. These are problematic parts of the world, and even the majors, with all their financial might, have not been able to deal with the consequences of trying to operate in those jurisdictions. So I think Canada is a safe bet, and I think it's going to be where you're going to see the industry continue to go and continue to grow.
John, your stock's up about 120% over the past 12 months, and every single analyst says you're a buy. 13 buys, 0 holds, 0 sells. Pretty good, John. Thanks for your time today. Appreciate it, sir.
It's a pleasure. Thank you.
Stick around. Much more Ask for a Trend still to come. Well, the spotlight on affordability opening up investment opportunities in housing. Yahoo Finance's Julie Hyman breaks it all down in Market Catalyst with Meredith Whitney, Advisory Group CEO, Meredith Whitney.
You can lower rates, but if prices don't come down, affordability still is very problematic. And there's another issue too, which is there's very low inventory and there's very low sales volume because they're a very low inventory. So 60% of existing homes are owned by seniors, people over 60, and they're not selling. So they're living in their homes for longer. They are aging in place, which means there's less property on the market and less inventory, churn. Which keeps prices high. And the other thing that happens is that when seniors and homeowners are facing the same affordability issues that so many Americans are, they are increasingly tapping into the equity in their homes. So there's 36 trillion of equity in homes, and I estimate there's about 26 trillion in tappable equity. Only just over 400 billion is tapped today, and that's again very low relative to historic basis. So if you looked at 9 trillion of equity back in the where the housing crisis occurred, there was over 700 billion of home equity available. So the dynamics are not going to improve anytime soon. So last year, 2025, there was just over 4 million in existing home sales, and the estimates this year are a little bit higher, but not much. So I think the existing home market stays gummed up, and the fastest growing loan category is home equity. We think that there's a home equity renaissance going on, so that more and more people are going to tap into the equity to make ends meet. So increasingly, more people are using home equity as a cash management vehicle, whereas historically they've used home equity for home renovations. That's down. Cash management is up. So you get into home affordability, which I think is going to be a central issue of midterm elections, and that's really going to focus then on new home building, and a lot of it then is going to focus on manufactured home building, because that is so much cheaper than the site-built homes.
Okay, so there's a lot to unpack there, Meredith. So let's slow down for a second and do that. We've talked before about the home equity boom the loan boom that you're predicting, and some of the potential beneficiaries of that, from companies like a SoFi to a Rocket. How do you think that's going to play out this year? And do you think that traditional finance will also get a piece and benefit, or is it just that it's so much a smaller part of their business that it's not as meaningful for them?
Well, Julie, you nailed it. So Bank of America is the biggest home equity lender, but it's a tiny part of the business, and not one they really focus on. One they extend to their high net worth clients, but one they're not interested in building that line of business dramatically. So it's really the non-bank players that have been the bigger growers. And so you had Rocket and SoFi be big in that space, and Rocket more of a home equity play than SoFi. SoFi we're recommending because it's an originate and sell model. So they've got so much interest from private credit wanting to buy their loans that they can originate and then immediately sell, which turns them into a much higher volume, higher margin play. But both stocks benefited last year. Now, both stocks were up 85 and 75% respectively, Rocket and SoFi, and they benefited from the fact that there's a very robust pipeline of home equity companies that are set to go public. So Figure went public in September of 2025, and both Rocket and SoFi benefited from margin expansion because of that deal. So they're about what we estimate to be a half a dozen home equity stocks set to go public. These are private equity funded companies, and private credit buys their loans. So private equity needs an exit strategy. They're on deck to go public. So there's a lot of momentum behind this sector, and there's a lot of demand from consumers who want these loans. So that's why we think it's a home equity renaissance and what we call a fat pitch investing opportunity here.
And by the way, Figure itself has also done pretty well since its IPO. The stock is still, I think, more than double the IPO price. I want to get into manufactured a little bit, because this is a fascinating area to me. And when we talk about manufactured, people are watching, we're talking about what we used to call prefab housing, right? You build it somewhere else and then you take it to the place, or it's easily assembled. People like Martha Stewart are now designing these kinds of houses. And in the past, I think you could argue there was something of a stigma around them. Does that go away in 2026? Do we see a manufactured housing boom?
Julie, I'm so glad you're as into manufactured housing as I am, because I could talk about it all day long. People look back on the pre-1970s as like a trailer park type manufactured housing. Manufactured housing today they're really nice. So not only are they oftentimes 25% of the price, but they're incredibly I would say high end, very, very nice. So what's interesting about this, and why we think this is also a fat pitch opportunity, is there are as little as 100,000 manufactured shipments annually. It bobs around right 100,000. So when you move manufactured housing, there's a requirement from the 1970s, which is a chassis requirement, where you have to move the manufactured home on a steel platform, and then you have to install it with the steel platform. So both the House and Senate bills repeal this really outdated structure manufacture this chassis mandate, and that would lower the price of manufacturing by an estimated additional 25 to 50%. And importantly, the Manufactured Housing Association on Regulatory Reform thinks that it will increase shipments from 100,000 to 500,000. So that's obviously a quantum increase, and what it would do to companies like Champion Home, Sky, would be massive. And there's Cavco that benefits as well. So these are quantum shifts in a business environment and volumes that could happen with the stroke of a pen from reconciliation from the House and Senate.
Stick around. Much more Ask for a Trend. That's still to come. After years of pandemic-era relief, a major shift is now underway for millions of Americans with student debt. Starting Wednesday, the federal government is restarting enforced collections on defaulted student loans, including wage garnishment. For more, we're bringing in Mark Kantrowitz, student loan expert and author of How to Appeal for More College Financial Aid. Mark, it's great to see you. Maybe you start big picture, Mark. Walk us through the news. What's changing? Why is it so important for borrowers?
Well, during the pandemic and for 12 months afterwards, borrowers didn't have to make payments on their student loans, and there was no wage garnishment or treasury offset of income tax refunds or Social Security benefits. And now that almost a year has passed since the restart of repayment, borrowers who are in default on their student loans are going to start seeing these enforced collection methods taking money out of their paycheck.
Can we quantify this, Mark? How many Americans are we talking about here that could potentially have their wages garnished?
Nearly 10 million. There are 3.4 million who have newly entered default on their student loans, and the rest have been already in default on the direct loan program and FFEL loan program on their student loans.
Who could have their wages garnished, Mark, and who cannot? What are the definitions, the lines here?
Well, if you have defaulted on your federal student loans, which means 270 days of non-payment, your loan is in default and enforced collections can occur. Normally, they would have a 30-day notice before the wage garnishment can occur, and you can ask for a hearing if you have experiencing financial hardship. The main categories of people who can't have their loans wage garnishment occur are it's just temporary. If you lost your job involuntarily, you can't have your wages garnished during the first 12 months of employment in a new job. If you have your loans discharged, say for a total and permanent disability, then your loans cannot be your wages cannot be garnished. And if you and there are a variety of other relatively esoteric, like if you file for bankruptcy, even though student loans are very difficult to discharge in bankruptcy, during the pendency of the bankruptcy hearings, the federal government cannot do enforced collections. And then once it's over, they can resume the wage garnishment.
How much can the government actually take, Mark, when we're talking about garnishing wages?
Okay, so wage garnishment can be up to 15% of the borrower's disposable pay, which is their adjusted gross income minus amounts required by law to be withheld, such as for taxes. And they must be left with at least 30 times the federal minimum wage per week. Since the federal minimum wage is $7.25 an hour, that means they have to be left with at least $217.50 each week.
So let me ask you, Mark. Let's say I'm listening to this. I think, you know what, I could be in the crosshairs here. You know, I could be looking at having my wages garnished. What do I do, Mark? What's the game plan? What are some tips?
Well, so one thing you should do is update your contact information with the federal government on studentaid.gov and with your student loan servicer so that you'll get notices about your student loans. The federal government has to send that notice to the most recent known address. And if you've moved in the interim, you're not going to get that notice. But they can still garnish your wages because they have your social security number. You should prepare to reduce your spending to accommodate the wage garnishment. If you haven't yet defaulted, consider switching into an income-driven repayment plan, which will be your most affordable option. Or if you have temporary financial difficulty, you could do the economic hardship deferment or unemployment deferment, which will still exist for now. For new borrowers starting July 1st, those are going away. You also have the option of a general forbearance, and these temporarily suspend your repayment obligation while you're getting back on your feet. I would also suggest that you save the money that will be garnished before the garnishment occurs so that you'll be able to ease your way into a new budget when your paycheck is reduced by up to 15%. And so long as you haven't yet reached the 207 days delinquency, you can avoid wage garnishment by simply bringing your accounts current. It may not be all the way current, but so long as you're less than 270 days late, wage garnishment cannot occur. And then to make it easier to repay your student loans, and you can increase your income by taking a part-time job in the evening and weekends, such as driving for Uber and Lyft, or creating widgets that can be sold on eBay or Etsy. And you can also try to cut back on your spending patterns so that you have more money available to repay your student loans and other financial obligations.
Mark, thank you so much for helping us think through all this. We appreciate it. That's a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet.